To what extent the tension of the last month is a substitute for rate hikes? To what extent do you expect there to be a significant tightening of lending standards across regional banks in America? What's the call on that now, Jim?
So the way that we look at this is that, look, clearly there is a tightening of credit conditions that's going on, but we also have to recognize that there's an easing of interest rate conditions that have gone on too. Rates have come down a lot. So there is a balance that we have to think about. And I think Krishna said it correctly. It's a cyclical issue at this point for what's happening with the banks. Now, in particular, the smaller banks, I should be very specific about that. The other issue that we have to think about, John, is what's the correlating agent here, right? This was an event. This was an important event that took place in March with the smaller banks. But did something also take place that created correlation risk, which created a sudden stop in the markets, that created a bigger problem, that had contagion? We didn't see that. And I don't think that we should look past that. And I think that's one of the reasons why we've been able to recover, that yes, there's going to be a credit crunch, not a credit crisis, but that credit crunch is going to take place over a long period of time. So it's not a sudden event, sudden shock event that creates a sudden stop in markets that creates that type of contagion effect that one would normally associate with a more systemic type of a problem.
Jim, to your point, it's the process. It's the beginning of a process that will play out over weeks, months, quarters, maybe even over the next year or so. With that in mind, Jim, can you make a call on how contained the macroeconomic spillover may well be from the shock of the last month?
Well, so far from what we're seeing, it seems reasonably well contained. I'm going to start with the dollar. So the dollar has been coming down. If you look at the Bloomberg Dollar Index, or if you look at other dollar indices, you're going to see that the dollar has been coming down in terms of weakness relative to other currencies. It's actually peaked somewhere around the beginning of the fourth quarter of 2022. We're not seeing necessarily spreads widen. CDS spreads widen substantially further than where they were before. Money markets, liquidity in the markets are still working well. So we're not really seeing the natural signs of a systemic shock. And typically you see that with a spike in the dollar value, because that's where a lot of long-term liabilities are placed and people need to buy dollars to cover their risk. And we're not really seeing that. So I would say at this point that much of this has been pretty well contained.